not merely to explain laws, but to help professional understand the thinking behind these law. And today's session is on takeover code, continue that journey. Friends, as you are aware, then when we started corporate professional, the takeover code was very favorite subject for all of us, and we were doing. And if you all remember, Sundarshan sir was there in our inaugural session. We launched takeovercode.com. That was one of the its kind, and we got a Tata Anian Hottest Startup Award also. And in this takeover law, we did thorough research. We provided entire calculation. We provided various parameters through the takeovercode.com. And Sundarshan sir also came for that program when Mr. Bhave, the then CV chairman, inaugurated our website, and we got award also. So this subject is very dear to us. And I was just wondering, sir, we came out 2 books on takeover code that time. The case laws, takeover code, 2 book हो गया उसमें. The takeover code compilation as well as the queries on takeover code, because this time so much confusion, so much issues were there. So friends, today I have just changed. Normally I'm speaking, I will give the philosophical aspects of this. And I remember, sir, you remember this book, we came out, SEBI Takeover Code, open offer book, and all the open offer book was there. And one query book was also there. Okay. So, and that query book was very popular, sir, and we lost we distributed all the books, and then I have taken one book from your side to keep my memories alive. Thank you very much, sir. So, Shivam, can you just give presentation? So now we, before discuss this regulation, let's just first understand why this law exists. So I have prepared this SEBI Takeover Code Philosophy, Practice and Emerging Future. And this is, we want to discuss on this issue. So first is the true purpose of this takeover code. The takeover code is not about acquiring companies. It is about protecting trust whenever ownership or control changes. Whenever control change, influence is gained, rights are acquired, and the balance of power shift because one promoter to another. That is precise moment the law asks one profound questions. What about the shareholders who are not sitting at the negotiation table? And sir, if you remember, in 2003 when I was president, and that time in 97 when this case law came on 20th February, it was first time it has come in the as a regulation, though it was earlier also, but that was not structured. And that particular time, I remember Mr. Bajpayee was the chairman of SEBI, and I was moving to various places and talking to professional, and everybody was saying this law is not applicable to us because we are not acquiring any company. And that time SEBI came out of 1,75,000 rupees penalty because so many company has not complied. When SEBI has asked that every end of the year you have to give, and whenever you are acquiring percentage, you have to inform. So me and Sundarshan sir visited the entire places, educating the corporates and suggested them that it is not acquisition, it is also for compliance point of view. So this is one background which I can proudly say that this is happening. So now just go deeper into this and understand the philosophy. So the philosophy is very, very clear because every great law survives because it protects larger public interest. The takeover code protect confidence in the market. So that's why we have to understand why society requires this regulatory architecture and the fundamental principle of market fairness. That we have to see this. But unfortunately, what is happening? Professionals often reduce this philosophy into a compliance checklist. And now we have to move beyond compliance checklist. There is a misconception. Law is strictly about corporate acquisition. That was the concept people were thinking this is, but law, this is a law of fairness, transparency, and equal opportunity. Then people were confused that regulatory roadblock to deal maker. They are saying takeover code is restricting deals, but it is protecting the unrepresented shareholders. Then mathematical compliance exercise that you follow this is the percentage, then you do is. So somewhere you have to give some yardstick. You cannot leave it open. So an equalizer of power during promoter restructure or strategic investment is taking place in the company. So the compliance is the consequence. Fairness is the objective of this particular law. Once we understand fairness, another question naturally allied. So you have to understand the philosophy is not merely a legal requirement, it is strategic necessity that dictate deal structure, valuation, timeline, and commercial viability. And sometimes it is protecting the existing promoters also, because of some investor has invested money and now he is dictating some terms which are not favorable to the promoter or the person who is managing company. That is protecting them also from if anybody from outside is creating some problem. So now we have to understand how actually this particular control word is there. So control has two aspects. One is quantitative, one is qualitative. The objective and subjective. So quantitative percentage shareholding, contractual right, affirmative voting right, board representation, commercial influence. These are the all things comes under control. Control is not just by 51% you are holding. So control is no longer merely a percentage now. It's a combination of all these factors which I mentioned, the affirmative right, board representation, and commercial influence. The future evolution of takeover law revolve around interpreting the exact spectrum that is very, very important, which we have to just understand. So this is one part. Next is the 20 years ago, we have just control leverage by percentage. Today, we talk about the principal influence. Now, next question is, which brings to the perhaps the biggest change in this in our professional practice. The practice, what is happening? How modern professionals apply this architecture in real boardroom practice, complex transaction, how they are managing, and ambiguous commercial realities, how they are overcoming this. So, Shivam, go back. So we have to understand the philosophy is most important. Applying it correctly is further more important, and it create value for the profession. Next. So now information, the era of judgment, not just access. So if you compare information and become commodity now, judgment remains a premium, because 20 years ago, there was a challenge that knowing the law and finding the provision. And I was always telling this, that this law, that time 45 section was there. It is most complicated law. And then interpretation and further interpretation. And then after so many years, there is another interpretation came that you individually and collectively. So people were earlier, people were thinking that if I'm acquiring more than 26%, then there's a violation. But the law that collectively or individually, that has changed so many things. So the first challenge was law, understanding of law, then case law evolution. So regulation were hard to access and cross-reference because it was new. But today what is happening? You go to the social media, you go to go artificial intelligence, they will just tell you and give the complete picture of these presentation. But now we have to understand when commercial arrangement, unintentional trigger, regulatory obligation that will come. We have to identify when investor become person acting in concert. We have to understand knowing exactly where commercial wisdom meets legal compliances, that we have to just say. So information and become commodity, that I have just told. Judgment becomes premium, that is always there. If judgment is a differentiator, In the next question is how to professional develop judgment. That is another part because everything is judgment. So how they should do the judgment. Next. So the law tree architectural framework. This particular thing, if you can see this, then you will realize that the professional must learn to understand the business first and not regulation and thereafter. So first is if you are talking to any client, the client is not interested what section with proviso. He is interested that I want to acquire this company. Can I acquire this? I want to induct this investor. Can I do this? Can I restructure my shareholding and I want to increase this? So these are the questions which promoters are asking. So this is the question, this is the base root. So understanding the fundamental purpose of the law, that is the fairness. You have to tell the management that where you stand. The section, subsection, that is a part of the leaves and the part of the trunk of the leaves of the trunk, that is not very important for the professional, for the promoter. He is interested that please tell me what you should do. So in our corporate professional, we have started asking different questions. Can every law be understood visually before it is studied technically? So that's why we have started giving presentation in our normal thing also to tell the philosophy. So understanding law is only one part. The second part is identify where professionals normally fail. So in a way, what is happening that we have created a law tree architecture. The particular portion that is a leaves, that is a part of the professional. The trunk, the base and root is a part of the management where they do the business, and in business what they want, that we have to interpret. So this way we want to create that how a takeover law and how these things can be managed. Next. So now what is happening, we have seen this, and Sundarshan sir will add this point, the building the professional risk register. What is happening, there are so many times, so many issues are there where people are confused. Trigger and identification risk. Will control inadvertently trigger? Are person acting in concert currently identified? These are the main points. Then execution timeline risk. Have acquisition threshold been computed flawlessly? Because here the timeline is very, very important, and the timeline following and the crossing is a violation. Are disclosure timeline mapped? Are claimed exemption generally available, which you are going, or after some time it will can reject, and then you are going for the bigger risk. Then ecosystem, like heavy weighted against FEMA and competition law, because that sometimes the other laws is also required. Are LOD or insider trading regulation accounted for? What is the valuation implication? That is another aspects which everyone should understand. So the professional excellence is measured how many violations we prevent, so, but not by how many we resolve. So we have to work out that our transaction which we are making in such a manner that we are following takeover law, then we should think that how we can save the violation, not we are just thinking doing this and then resolving. So this, for every successful transaction, this risk register is very, very important. But next is the profession is also changing, because today we have seen the takeover law, how it is started, how it is moving now, what is the future? Because future, we are anticipating how changing capital market, new instrument, new market size, foreign investor, emergent technology, new business model, complicated transaction, that is will reshape the regulatory framework. That is very important. So the question is, will tomorrow takeover transaction resemble today's? Answer is not, because you have to change the entire thing. The way you are thinking will not survive. Now, what are the multi next? So the every professional who wants to do this, every corporate who wants to do transaction, they have to understand not only company law, competition law, FEMA, valuation and taxation, very, very important aspect of valuation. Data analytical and AI is also there. Digital business, which is coming, which will change the face of this. Then digital corporate governance issue, that is also there. So tomorrow the advisor will remain isolated as a pure securities law expert, because transaction will bring out new inherent multidisciplinary approach and knowledge they have to do. The future advisor will not compete because he knows more law. So a future advisor will compete because he connects more discipline, because they know, if I have a knowledge of takeover law, that is okay, deep knowledge, that is okay, but I have to expand now and understand the other laws also, which is taking care of modern takeover strategy. That is very, very important. Now, next decade, navigating the next decade of complexity, which I was just mentioning. The takeover law will not doing all these things. AI driven investing, that is also taking algorithm trigger, automated capital deployment. All these things are taking place. You have a algo trading, and you told somebody to sell this, to tell the system to sell this. And sometimes you're telling system to buy this, and you are getting and crossing the threshold limit automatically without knowing. So these are things you have to manage. This cross-border M&A is taking place. So you have to just understand what is the definition of multi-jurisdictional control. Digital first companies valuing. Now, today, what is happening? The companies are going digital and the valuation is unreasonable. So valuing and acquiring borderless digital entities, that is also very, very tough job. Founder control tech. Today, what is happening? The founder is there, but he's not a promoter. So entire thing is moving around him. Investor is putting money on the basis of him, but he is not controlling. Sovereign wealth fund is coming in India continuously, like pension fund. Another mega fund is coming. Shareholders agreement is becoming complex. You do this, then you will get this. ESOP, various other aspects are coming. ESG driven activities taking place. People are following the governance aspects. Data is an asset. Control over data is important than the control definition, which is I have already explained. So I'm controlling data, I'm controlling platform, but I'm not controlling any equity, or I'm not giving any instruction. That is also another question. So the law will undoubtedly evolve, but professional must evolve even faster. And this is not a prediction. These are the conversation already begin across boardroom on all these points, which will be affecting the takeover law. Next. Now, there is a very important message I want to give to all. The shared objective, compliance versus value creation. The regulator, he has created a structural framework. The professional help business navigating the framework responsibility. But there is a shared goal of both. The regulator want a perfectly fair market, transparent disclosure, unshakable investor confidence, because minority shareholders nobody is protecting. So the regulator plus independent director has to do efficient capital formation and strong corporate governance. These are the things. So people often assume regulator and professional stand on opposite side. They are the two north and south pole. In reality, when both understand each other's perspective, compliance is to be legal obligation and becoming a driver of corporate value. So this is the important part which we have to just understand. Next. Every law should ultimately answer 5 questions. When we are talking about the takeover law, same thing will apply here also. If you understand takeover law, You have to ask why this law exists, philosophy. How does it work, practice? Where do professionals make mistake, risk? How does decision be taken, that is a judgment, and where the law heading, that is a future. So I have covered all 5 parts. So understanding a law begins by asking the right question, not merely to ensure compliance, but to build sound judgment, manage risk, and anticipate the future. So this is the basic point which we have to just understand. Next. So the mandate for professional, it is not, today's webinar is not for about remembering regulation 3, 4, 5. It is about becoming a better professional. So master the philosophy, protect fairness and market integrity, evaluate the practice, apply judgment to prevent violation before they occur, and anticipate the future, that how the build multidisciplinary expertise for the digital decade. So everybody should understand that how things will change. So to build better professional strength, corporate governance, and contributing to a more transparent and trusted business, it is most important thing that we should ask ourselves, that how this environmental things will take place, and continuously we should learn this. So friends, this is the basic part which I have given. Now I welcome our today's chief guest, Mr. Sundareshan. And we are privileged that he is there. He's a distinguished professional who has been closely associated with the evolution of Indian securities regulator framework, and especially the framework of takeover law. There are very few people in the market who have observed the development of Indian capital market regulation from such a close quarter. We look forward not only to understand that what law says, but also why it evolved in this manner, where professionals continue to face genuine interpretation challenges, and how the future of takeover regulation may unfold. So these are the points which I request Sudarshan sir to speak, and I welcome you, sir, for this program. And simultaneously, I welcome all other my colleague of corporate professional who are working in the takeover law division. Manoj Kumar, partner M&A and investment advisory, investment banking, and he is looking after a takeover of us. Ruchka, she is associate partner, investment banking, corporate professional. She looks after the open offer execution work. Then Ravi Prakash, associate partner, securities law, corporate litigation, corporate professional. Ravi looks after the litigation part of the takeover law. And Nitin, manager M&A and investment banking. He is working with Ruchika for doing takeover law transaction. So with these knowledge, these things, and we have come out more than 50, or I think around we are reaching to 100 takeover offers which we have given. 1 year we were the highest 16 offer we have given in the country. In I think 2016, 17 or 18 we have given. So with these things, I hope that our team which is working in the takeover law is always very close to our heart. So I welcome Sudarshan sir, I welcome all these people and their knowledge and nitty-gritty and understanding the concept, because this is a one complicated topics will come to us. So friend, this is very important part which we want to discuss, because it is a very close subject to me. So I was just wondering what is the issue, how it can happen, and what is the future. And I will request now Sundarshan sir to speak, because you have worked in this department, and I will, without mincing the word, I can say, if anybody in India, if anybody has any takeover code problem, you talk to directly Sudarshan sir. He is the person who is expert. He has drafted this, he has worked this, he has modified this, and he has given interpretation of various things. So over to you, Sundarshan sir, your advice on this subject and the future. What is future where the takeover law has to modify, change, and other thing. Then we will have, after this, after the all the presentation, After Sudarshan sir, Ruchika, Nitin, and Ravi will give presentation, and then Manoj will take up the question with Sudarshan sir. Over to you, Sudarshan sir.
Good evening, Mr. Pawan. The other speakers from corporate professionals, the participants, and all others. I thank Mr. Pawan Kumar Vijay and the corporate professionals for giving me this opportunity to join this program and also share some of my thoughts on this subject, which, as Mr. Pawan said, is very close to my heart. Although I worked in this department at different points of time in SEBI, I tried my best to keep track of important developments in this field of activity. As it was very interesting for me to, interpret these provisions of takeover regulations. Mr. Pawan has very nicely covered the philosophy, practice, and the challenges. Let me just share some of my thoughts, having been, drafted and administered these regulations for over almost 3 decades. The regulation has three important parts. One is the disclosure part. The second is when certain conditions were breached, whether it is a percentage of acquisition or qualitatively acquisition of control, which may be direct or indirect, there is a need to make an open offer to provide an exit opportunity to the public shareholders of the target company. The third aspect is that there are certain situations because of which these conditions would be breached, and insisting on the open offer obligation may not be reasonable. Therefore, the the law specifically provides for specific exemptions, and also a panel has been constituted under the takeover regulations. The situations which were not covered specifically will also be referred to that panel, and the panel recommends, to grant exemption or not, and then SEBI passes a speaking order why the exemption is granted from the obligation of making the open offer or not. In this process, two important aspects to be kept in mind, which Mr. Pawan correctly said while, triggering those conditions. One issue which is being normally faced by the people is the collective acquisition which the regulator always looks for. The word persons acting in concert has become a household name because this has been used, borrowed from the takeover code and extended to various other laws, whether it is identifying the promoter group, whether it is identifying the sponsors in case of a mutual fund, or whether the people who are acquiring shares in the market, for the purpose of, manipulation or any other purpose. SEBI uses these persons acting in concept, time and again. And the second aspect people, miss out is that at what point of time the qualitative factor, that is the control, gets triggered. So I will just touch upon these two topics and tell something about this open offer. As far as disclosure is concerned, I think people have become familiar now that at certain levels it has been, almost every institution has automated the disclosure, and the exchanges have also, based on the data available with them and in cooperation with, just depositories, automatic disclosures of the system-driven disclosures are being put in place. Therefore, breach of disclosure requirements have become very rare, which was one of the biggest problem we faced 20 years back when Mr. Pawan referred to that, Institute of Company Secretaries and SEBI partnered and traveled together from Kanyakumari to Kashmir to address the, various professionals about these disclosure requirements. So that is being taken care of, and I don't see any problem now, whether it is at 5% and then, at a different, creeping, what you call this, further acquisition and all those things. Because the disclosure, because of technology, it can easily be done and it is being done. I find rarely cases where the disclosure has been breached. One of the points in this regard is there is always a confusion whether disclosure under takeover code and disclosure under PIT regulations have to be made independently because when I make one disclosure, will it not suffice? One thing has to be understood clearly is the objective of disclosures under takeover regulations is different from the objective of disclosure under PIT regulations. So, therefore, these two things have to be considered as independent, and these two things, disclosures, have to be done as required under the respective laws as and when it is triggered. Now, the coming to this persons acting in concert, the concept is very clear as per the, what you call in the matter of BK Modi, in the matter of Modi Rubber Limited, persons acting in concert basically refers where minds of two or more people are on the same objective of acquiring shares or control or voting rights. Now, the purpose has to be acquisition of voting rights or control. If just because two people have gone to a restaurant and had dinner together, that does not mean they are acting in concern for the purpose of acquiring shares. The minds have to be met for the purpose of acquiring voting rights or control of a particular corporate entity. The two people may be friends. Two people might have traveled together. Two people may be even, staying together in the same house. But you cannot simply say they are acting in concert unless it is able to be established that both had an intention to acquire voting rights or control. This acquisition of voting rights and control is the test which is to be applied for the purpose of persons acting in concert. So, and second aspect is at what stage your control is triggered because it is a qualitative aspect. I would request all the people to please go and see the order passed by SEBI in the matter of Jet Airways, where SEBI clearly listed out under what circumstances a control is deemed to be acquired, and also what are the rights which an acquirer probably may acquire may not trigger the control aspect at all. So, after a lot of deliberations, SEBI even thought of coming out with a bright line concept, but subsequently, because of this Jet Airways order was very clearly brought out, the intentions of that the bright line aspect. So no further bright line references were made officially by SEBI. So anyone who wants to understand at what stage a control gets triggered, the best test is to go by the parameters listed out in the Jet Airways. Now, having said that, at once certain conditions are triggered, the open offer obligation gets attracted. Now, let's see between 1994, 1997, and 2026. Now we are beginning, when the first regulations came in 1994, it is almost more than 32 years actually. Now, at that point of time, whenever there is a trigger, whether it is a percentage of shares or change in control, open offer has to be made. Now, I want to raise this question. What is the success of this regulatory requirement over a period of time? What is the purpose of this open offer? The purpose of or the objective of the open offer, as Mr. Pawan very correctly pointed out, was the person who is not sitting on the negotiating table and the person who is not party to the exit, which was negotiated by one person with the other, what is the chance for them to exit if they are not happy with the incoming person? So, if you go back to early 90s, what are the ways available for an investor to exit? One is if a tender offer is made by the acquirer or stock market mechanism. What was the depth of Indian stock market in 1990s and what is the depth of Indian stock market today? In 1990s and even up to 2000, if you see the depth of the Indian market was not as desired by the regulator or by the market because the liquidity was low, the funds available with the people were less, the number of investors who were trading were low. So because of all these factors, the exit opportunity for an investor to exit from the market was limited. Therefore, whenever there is a substantial acquisition, that percentage varies for a period of time. It started with 10, went to 15, now 25. Creeping acquisition was 2, sometimes it was made to 10, then subsequently brought down to 5. So when these breaches were there, open offer obligation gets triggered. The objective was to provide exit opportunity to those shareholders who were not party to the negotiation, and therefore we need to facilitate to exit in case they want to exit, because the other option for them to exit was through the stock market mechanism, which was not so liquid at that point of time. Now let us travel to 2025, post-COVID time. What is the market situation? Then let us see in all those open offers made in the last, say, 20 years, starting from 2000 to 2026. If you take 25 years, recently I happened to meet one of the professional who was actually conducting a, he was doing a PhD in Takeover, and he wanted to discuss with me about my views on the paper which he has coming out with the thesis. So when during the course of the discussion, what the data which he presented to me was that except in a handful of open offers made in the last 25 years, the response was hardly anything. In a substantial number of cases, the, the number of shares tendered by the public shareholders were actually zero. So what the data indicated was that this open offer has become more of a compliance and a tick box than serving the objective for which it was originally envisaged. As Mr. Pawan pointed out during his session, that over a period of time, as professionals, we all think of only complying without realizing whether that is serving the purpose or not. So, for this, through this webinar, I want to raise this food for thought to all the people and subsequent speakers. If they have any idea, they can also share on that. Now, do we require that at every point when these breaches have been done, a open offer has to be made? Why I'm asking is, what is the objective was to provide exit opportunity to the shareholders. It has been given in the last 25 years. How many people have made use of it? In how many open offers, the open offer price was more than the market price. Therefore, in whatever data which the so-called student or someone who was actually doing the PhD shared with me was that you can count the number of open offers where there was response from the public shareholders, which indirectly means in substantial number of shareholders, when the open offer obligation has got triggered and became public, the market has taken that into account, and the market price was invariably higher than the open offer price. At least earlier, there was a problem of, tax problem between a tender offer and what you call a secondary market exist. That has also been resolved by making this tender offer itself to a stock exchange mechanism. So when it is tax neutral, what is the benefit or the purpose which this takeover open offer has achieved? So what I want to, the point which I want to make is that, do we move on from a stage where we mandated this open offer from that point of view where the liquidity is substantially high? Now, what is that substantially high percentage may have to be worked out based on the data to be, trading data to be analyzed from the stock exchange. Today, we have a concept of frequently traded and infrequently traded, and there is a percentage of shares which gets traded in the last 26 weeks or in 12 months that is considered as frequently traded. If the share volume is less than that particular percentage, it is considered as infrequently traded. So similarly, if for example, in case of infrequently traded shares, one can say open offer has to be made mandatory because there is no exit opportunity available for the shareholder. Therefore, this open offer may help if someone wants to exit. Coming to the cases where the shares are substantially traded, where is the need for making an open offer? Because so far the experience is that it is becoming more like a tick box, and shareholders are preferring to exit through the stock exchange mechanism than through the tender offer. So what I want to say is that, can we think differently in future? going forward, can we say if the frequently traded is such as say higher percentage. So for today, if it is considered as say 10% for frequently asked, frequently traded shares, can we say if the shares of the company's trading volume is say 25% or more of the shares available for public trading, in those cases, though there may be a open offer trigger, disclosures can be made. There is no need to go for an open offer. Because what is the purpose of making this open offer when there is a exit mechanism available in the market and which is available throughout? There are some jurisdictions where whenever there is a takeover offer, the exit mechanism through the stock exchange is actually frozen. In those jurisdictions, this is the only opportunity for the shareholder to exit, and therefore this is very useful. But we follow a system where trading in the secondary market is independent of this open offer. So when such an opportunity is available and people have been taking advantage of that to over the tender offer in the past in many cases, is that necessary to continue with this open offer obligation in the today's context? The data which has come to my knowledge shows that there is a need to have a rethink on that. Now, at what percentage you will fix, whether it should be 25%, whether it should be 50%, whether it should be considered on the floating stock, whether it should be considered only on the true public holding, whether institutional trading has to be taken or not, broad deal window transactions to be considered or not, all those things need to be debated. And if some sort of conclusion is arrived at, I think going forward, the biggest change which I would expect in takeover code could be that this open offer requirement may not be made in respect of certain aspects. For example, I can give you one of the famous cement companies, which was taken over by one of the biggest industrialists of this country. Now, that company shares are traded so widely that nobody, not even a single shareholder, tendered shares in that open offer. What is the need for that? I mean, going through the entire preparing this offer document, and that person who is taking over is also already a listed company. So the data available about the acquirer is already available in the public domain. So I don't think any useful purpose is served, and therefore this is a food for thought whether we can think of dispensing with the open offer obligation, in certain cases where exit available in the market is much more, is better than the tender offer itself. Having said that, the minority shareholders have to be kept informed, proper disclosures have to be made. There is no, what you call, second thought on that. But at the same time, the shareholders also must understand that so much of time is which is being taken from the time a public announcement is made that so and so has occurred and the impending open offer is going to come. Invariably, there is a period of about 45 days. During the 45 days, there are so many factors which influences the market price. Now, those things are not factored in the tender offer price. Tender offer price becomes static, whereas the market price becomes so dynamic. So, if there is a well-established secondary market available, I think certain cases this open offer is not actually serving the purpose for which it was originally envisaged, because at that point of time the market conditions were very different. Today's market conditions are different. So, with this, otherwise the regulatory provisions are quite comfortable. Then one more issue which is of late coming out, and of course, which is not in the, much in the media, but recently there was a sad order regarding an open offer which has been announced but has to be withdrawn. Generally, the view taken by the regulator is that except for non-receipt of statutory approval, once an open offer is made, it cannot be withdrawn. But today, the situations have become so dynamic, so many challenges are coming. And if although the regulation has prescribed 3, 4 conditions under which the open offer can be withdrawn, but now there are new situations coming. Even in those situations, if the acquirer approaches the regulator for withdrawing the open offer, so far the regulator takes a stand that once an open offer is made, it has to be completed. Recently, there was a SAT order about a fortnight back telling the SEBI to pass a reasoned order as to why the withdrawal request has not been accepted and why the open offer has to be completed. Because as per the media report, what it says is that the acquirer has represented that by doing the complying with the regulatory requirement, more harm will be done than by withdrawing from the open offer. I do not know the full facts of the case because I have no access to that except from what is available in the media reports. So in such cases, I think we need to apply a different yardstick. Whether withdrawal can also be permitted if the transaction could not go through for certain genuine reasons. These are the two things which I feel, going forward, we need to rethink as to what we did 10 years back or 15 years back and what we are planning to do in in the next few years, because this is going to have a lot of impact. This will reduce the cost of acquisition. Because today we are talking about ease of business, and every day, every hour is time is money. And therefore, by incurring so much of cost, where the outcome is actually well known that it is going to be zero, whether the cost can be saved for the acquirer. Because in some cases, escrow money has to be blocked for more than 3 months. Now somebody has to block, say, 400 crores. 400 crores blocking for 3 months. What is the purpose? If that 400 crore can be deployed elsewhere in a more productive manner than making this open offer, will it not serve the investors of that company of the acquirer than blocking these funds? So we need to think in these type of angles and see whether these two reforms can be thought of. And with this, Mr. Pawan, thank you very much for the opportunity. And I will look forward to the presentations of other people. And if there is any query, we can discuss on that. Thank you very much.
Thank you. Thank you very much, sir. Your point or relevance of takeover of certain companies, and this is not one company, sir. You have given example of a company which is very big and listed. But I'm giving you one example. I'm giving multiple example. Whenever a company which is not doing any business, which has no value, even if any promoter, any new acquirer is coming out with that company, the shareholding, nobody is surrendering the shares because they think that company was not doing earlier. Now somebody is coming new, he will do something. So no, so if you take the data of these companies which has come out with the open offer, you will find very minimal percentage of surrendering by investors. So you are absolutely right. Some other mechanism, some other thing should also be worked out. We have done this journey since 97 to till date. Lots of things has changed. Future is also there. We have to modify things. Thank you very much, sir. Your presence will definitely help all of us, and we will have a question answer at the last. That time it will be very useful to take your views. Okay, now Ruchika, the entire thing sir has given the tone, and he has mentioned the future also. He has mentioned the issues also, and something which may be relevant earlier, which was relevant earlier, not relevant today. Now over to you. Please explain for the purpose of this that how to understand this takeover law, how the company should take care, what problem they are facing, how to manage this, everything in this. You, Nitin, please tell us.
Thank you, sir. Thank you for giving me this opportunity. And thank you very much, Sundareshan sir, for giving us such a good food for thought, because that's a challenge which we face every time when we see these sort of cases where sometimes when we make public announcement and at the time of opening of offer, the pricing market goes beyond and nobody tenders. So we also see and we also have a lot of thoughts around it, what can be done. It's very, your views were very insightful for us. I will just quickly run around the substantial acquisition, taking control, majorly the two sections which Sundareshan sir has also mentioned. One is about triggering, the other about exemptions, and then my co-speaker, Mr. Nitin, will talk about the disclosures and the procedure around how the open offer procedure works around. So I will not take much of time and will start with my presentation. So takeover regulation, for clarity and of everyone, all the participants, is applicable in cases of listed companies, and it is applicable on the persons who are either holding any shares in the listed company or who intends to acquire shares in the listed company. It can be substantial shares, it can be 5%. Since a lot of disclosures are now system driven, so a lot of initial disclosures which were earlier required are not specifically required to be made right now, but there are still certain transactions wherein specific disclosures has to be made by the acquirers or by the acquirers along with person acting in concert. So those are the persons on whom the applicability of takeover regulation get attracted. Now, coming on to what exactly the takeover is, in simple layman language, it is basically the acquisition of substantial shares or voting rights or control over the target company, and it can be either directly or indirectly. It can be either by agreeing to acquire certain shares or directly acquiring certain shares. So, all the scenarios which anyone can foresee while acquiring shares in the listed company are covered under the takeover regulations and defined in the definition of acquisition. Who can be the acquirer? As I mentioned, acquirer can be any person who acquires or agrees to acquire shares or voting rights or control over the target company, and the acquisition can be either effected at the time the acquirer is becoming acquired, or the acquisition is in agreement. So let's say if someone enters into an agreement to acquire substantial shares, that person can be categorized as acquirer. The answer is yes. If someone has acquired certain shares, is that person the acquirer? The answer is again yes. So to better clarify it, there are two questions. Merely entering into a share purchase agreement to acquire substantial shares, does that alone makes a person as acquirer? The answer would be yes, because he is entering into an agreement to acquire shares, not directly acquiring the shares. And even in the cases where the preferential allotment is approved by the board of the listed entity, upon approval of the board, also that allottee becomes the acquirer if that allottee is acquiring substantial shares, which we'll talk about in the following slides. So that person would be categorized as acquirer, and all the obligations under takeover regulation runs around the acquirer. So as sir also mentioned, talked about the very significant term person acting in concert, I would also like to throw some light on it. So person acting in concert is a definition which is defined as well as not defined under takeover regulation, because it is divided in two sections. One section which deals with a person which is very inclusive in nature, and which deals with persons who has any common objective or purpose to acquire shares along with the acquirer. So if someone is joining hands with the acquirers, is acting in concert with the acquirer to acquire substantial shares or voting rights or control in the listed entity, that person would be categorized as person acting in concert, irrespective of the fact whether that person has any prior relationship or any sort of association with the acquirer. And then the other part of the definition talk about 13 or 14 list of categories where common directors, immediate relative, member of promoter and promoter group in case of any entity, their directors, subsidiary holding, all those will fall under this category. So person acting in concert is very crucial, because in all the triggering regulation, the threshold needs to be checked individually as well as with the person acting in concert. So to understand who all would be categorized as PAC of acquirer, that becomes crucial while interpreting this law. Now, we are talking about the acquisition of shares carrying voting rights. So what does shares constitute here? So shares in the equity share capital of the target company carrying voting rights, and including any securities of which would entitle the acquirer to carry voting right, and all sort of depository receipts which carry any entitlement to carry voting rights. All these would be categorized as shares for the purpose of takeover regulation. Any sort of temporary embargo on the shares which would hamper the right to have voting rights would not be considered as share. Let's say if the shares are partly paid up, then to the extent the value is paid up on the shares would be categorized as the shares carrying voting right, and rest would not be categorized as shares for the purpose of this regulation. Otherwise, those are shares, but for the purpose of calculation here, it would not be categorized as shares. Now, talking about acquisitions, so acquisitions can be of two types, as Pawan sir also mentioned in the initial slide. So it can be direct acquisition, it can be indirect acquisition. Direct is when any acquirer directly acquires substantial shares or control over the listed entity and triggers the requirement to make open offer. Then there is another regulation, another set of provisions which talks about that if any acquirer acquires shares or control over any private entity or over any entity, LLP, or any group through which they are indirectly acquiring control over the listed entity, those are also covered here. And upon acquisition of shares in that private entity, the open offer requirement on the listed entity would also be attracted. Then coming on to types or classification of acquisition, these can be of two types. One is friendly acquisition, which we see in most of the cases happen, where the exiting promoter and the new acquirer who wants to acquire control and management rights in the company, they join hands, they decide, they negotiate on a price, and then the transaction or the agreement to sell the shares happen, and then the open offer gets triggered. And the other sort of transactions which are very rare are hostile nature of transaction or acquisition, wherein any person tries to gather the shares substantially from public and then make a hostile takeover open offer to acquire substantial shares and control over the target company. So those are very interesting cases, but very few to see, and there were very less in past in India. I've seen there were many in US or other countries, but in India there were very few cases of that nature. Now, directly coming on to the thresholds which are there for triggering. So the initial threshold, or I would say the mandatory first threshold, which attracts the trigger or which attracts an obligation to make an open offer is of 25%. So any person who acquires or breaches the threshold of 25% would have to make an open offer as per SEBI takeover regulations. And this is the initial threshold. While for the calculation of this initial threshold, the prior shareholding of the acquirer is to be checked. So let's say if an acquirer is holding 10% and acquires additional 15%, then the 10% and 15% jointly would be considered while calculating the initial threshold. Also, the threshold of person or the shareholding of person acting in concert who are holding prior to the acquisition of this or breaching the limit is also to be checked. And the special thing about this regulation is we'll talk about certain illustration in the following slide. But the special thing about this regulation is that this limit of 25% is to be checked on individual as well as aggregate basis. So let us come to the illustration to explain it better. So let's say if this is the first illustration where Mr. A holds 10% of the voting rights in the company, and then Mr. A acquires additional 15%. So 10 plus 15, it triggers the requirement of regulation 3.1. Then if Mr. A does not hold any shares and acquires directly 25% in the company, it again triggers the requirement of regulation 3.1. Then in another example, if Mr. A holds 10 and the immediate relative of Mr. A, Mrs. B, holds further 10% and Mr. A acquires additional 5%, so individually Mr. A is holding 15%. But by clubbing the shareholding of his wife, he is triggering the threshold of 3:1, so the provision would be attracted and open offer has to be made. In another, now this is the example where, individual as well as aggregate limit is to be checked. So Mr. A, together with person acting in concert, is holding 30%. In clubbed, they are beyond 25%, but Mr. A is holding 24%, and the pack, whosoever is in pack category, is holding 6%. And Mr. A acquires additional 3%, through which Mr. A crosses the benchmark of 25%, reaches from 24 to 27. Then again, there is a trigger event of 3:1. So this is the situation which I was mentioning. It is coming out of Regulation 3.3, which talks about that all the limits which we discuss under Regulation 3.1 or 3.2 has to be checked either individually as well as aggregate. So aggregate is there directly in the provisions, but individually also we have to check. That is specifically written in Regulation 3.3. Now coming on to second important regulation, which is creeping acquisition. Now we have talked about the first initial threshold, which is 25%. So that's the first barrier. When you cross it and you are beyond 25% but holding less than 75%, then whatever you acquire, you have to either acquire within the purview of Regulation 3.2 and not trigger open offer, or if you breaches the threshold, you have to make an open offer under Regulation 3.2. So the limit is of 5% of the voting right in a financial year. So for the calculation of this threshold, the shareholding of acquirer along with PAC as well as individual shareholding, both is to be checked, and the holding should be more than 25%, less than 75%, and if someone acquires more than 5% in a financial year, then the open offer obligation would be attracted. So as I mentioned, so the overall limit is overall limit is to be checked between 25% to 75%. Also, in this creeping acquisition, there is a proviso which says that no agreement to acquire any shares can be done which takes the holding beyond 75%, which is the maximum allowed limit for the non-public shareholders to be in the listed company. So to explain it better, I have certain illustrations. In the first case, Mr. A, along with the PAC, hold 30% of the voting right. Mr. A, together with the PAC, acquires additional 5% in one financial year, and Mr. A triggers the requirement of 3.2 along with the PAC. Now, in other case, Mr. A, together with PAC, holds 74% and wants to enter into an agreement to acquire 5%. This cannot happen as per the exception, as per the proviso which I just mentioned, because under 3.2 you cannot go beyond the threshold of 75%. Now, how to calculate the threshold of 5%? That is very crucial and very important, because the explanation under regulation categorically says that gross acquisition alone shall be taken, and there no adjustment of any intermittent fall or disposal or dilution pursuant to any fresh issue in the company should be done while calculating the limit of 5%. So that is one thing. The other proviso also explains about whenever there is any change in the shareholding, whenever there is any fresh issuance of shares, then the change of 5% is to be calculated by deducting the post percentage holding to the pre-allotment holding. Post-allotment minus pre-allotment, whatever the change is, that needs to be taken into consideration while calculating the limit of 5%. Now we'll understand it from the examples here. So in the first example, let's say in this financial year, the holding of acquirer was 30%, on market acquisition of 2.5%, then on market sale of 1.5%. So if in general scenario we'll do the deduction and we'll say that there is a change of 1%, but that is not the case. You'll have to redact 1.5 sale and then only club 2.5 and the increase pursuant to preferential allotment of 4%. So the aggregate acquisition for the purpose of calculation under 3.2 would reach the acquirer holding to 6.5 in this financial year, and the trigger or the open offer obligation would be attracted. In another example, the shareholding of acquirer is 30%, on market acquisition of 2%, dilution pursuant to increase in capital is of 1%, and increase pursuant to preferential allotment is 4%. Again, it is beyond 5%. So again, the creeping acquisition limit would be attracted. Now, the third example is clearly about the fresh issuance of shares, where the pre-preferential shareholding is 30%. Pursuant to the preferential allotment, the shareholding is going beyond 33. So basically, it is reaching to 33.33 as it has to be calculated on the post allotment capital. So the change is merely 3.33%. If you see in terms of number, it looks like that 5,000 shares are being acquired, which would be around 5% of the pre-capital, but the change has to be calculated basis the post allotment percentage minus the pre-allotment percentage, and there is no trigger situation. Then in another example, we see that pursuant to the allotment to promoter 1, the change is coming out to be 6.36%. However, the overall promoter shareholding is not changing beyond 5%. It is still remaining to 3.64%. But the individual promoter 1 has to make an open offer because he is already holding beyond 25% and attracting the limit of 3.2 here. So these are the examples through which one can understand how regulation 3.1 and 3.2 both limits can be calculated. Now coming on to another very important regulation which Sundaresan sir also talked about is regulation 4, and it is a regulation where numbers and quantitative measures are not very important because it starts with the term irrespective of any change in the shareholding. So it talks about if any person gets the right to appoint majority of director, if any person gets the right to control the management or the right to control or change the policy decision, it can be either directly or indirectly through shareholding or any management rights or agreement, then the control is triggered. Now, this is an indicative list. Control definition is inclusive in nature, and it can include a lot of various other scenarios which are not directly written or covered here. So that is why we have to refer to Subcom Ventures, we have to refer to Jet Airways, where the distinction between having protective rights and management rights or controlling rights is given. So in cases where any sort of agreement happens and the investor get the protective rights over the investment which they have made in the company, in those scenarios the trigger of regulation 4 doesn't happen, because it merely gives the right to control their or merely gives the right to protect their investment through having certain veto rights or having certain checks and balances to the extent their money is being used for whatever purpose they have invested. So that is the distinction one has to make while identifying whether the control is shifting or not. And otherwise, of course, the control can be shifted de facto pursuant to any person having more than 50% shares in the company, which would automatically give right to appoint majority of directors in the company or in the listed entity. So those parameters need to be checked while assessing whether actually the control is getting transferred or not. And in 2018, as the bright line test came, but I think the best case scenario to evaluate is to read Subcam Ventures or to read Jet Airways and draw the line where the control can be shifted or can be assessed that there is a change in control or not. Now coming on to another regulation which talks about indirect acquisition of shares and control. So in cases where acquirer acquires any other entity which is not listed, any private entity, through which it ultimately acquires control over the listed entity, there are certain parameters whether it can be deemed direct, basically deemed indirect acquisition, or if the control is not beyond 80% in the end listed entity, then there is certain other scenarios to understand it. But this is the regulation which captures all those scenarios which doesn't directly fall under regulation 3 or regulation 4. So it gives the way to cover all the indirect acquisitions and bring them into the purview of takeover regulations, and hence the obligation of open offer and everything will follow. Now coming on to voluntary offer, this is also one specific regulation, regulation 6, which talks about or which deals with the cases where the prior holding of acquirer is beyond 25% but less than 75%, and that acquirer has not acquired any shares, acquirer along with PAC has not acquired any shares in last 52 weeks and want to give an open offer. That is a voluntary open offer, and it can be made for 10%. So in general scenario, whenever the open offer is triggered, my co-speaker will also speak about it, then the open offer has to be made for 26% shares. But in voluntary open offer cases, it can be done, it can be made for minimum 10% or above, but less, not 26%. So this is a special case where any acquirer or already the person who are holding 25% can make a voluntary open offer to consolidate their shareholding. Now, another provision which talks about delisting offer, this was introduced in 2015. So this is a special provision created within takeover regulations to allow acquirers to make an open offer by entering into an agreement or maybe by acquiring substantial shares in the company, but they do not have an intention to carry the company as listed entity. So they can make a takeover open offer, do the announcement within 5 working days, and thereafter they can show their intention that they want to do delisting of the company, and then they can follow the procedure of delisting. So if the delisting process is successful, that 90% of the shareholders agrees for the tenders in the delisting offer, then the delisting is successful and they need not to follow the takeover provision or the takeover code compliance. But if delisting fails, then they have to come back to the takeover regulations and follow the procedure of takeover regulations, file the draft letter of offer with SEBI, and do all the things as is done in any normal takeover open offer case, subject to enhancement in the offer price by 10% for the delay period. So that is a special provision, because earlier when this amendment was not there, whosoever wanted to delist the company post acquisition has to first follow the 4 to 6 months procedure of takeover open offer and then delisting. Now this is a special carve out created for all those acquirers who want to directly delist the company post acquisition. Then another concept is about, very interesting concept is about competing offer. So in general scenario, when the open offer is given by any acquirer, then he has to follow the procedure to acquire substantial shares, but there is a window of 15 working days from the detailed public statement. So when the open offer comes, the public announcement is made. Post public announcement, within 5 working days, detailed public statement is to be published in the newspaper. Post detailed public statement, there is a window of 15 working days, roughly 21-22 days, where any person who wants to make a competing offer for the target company can make a competing offer. And if in that competing offer, so basically if that competing offer comes, both the offers can run parallelly, and then SEBI may decide who has more shareholding and who is more in the control of the company, may proceed with the tendering procedure and everything. So that is another opportunity available for any other acquirer also to jump in between and acquire shares or control over the listed company. Now, when the open offer has to be made, so in cases where any share purchase agreement or share subscription agreement or any sort of agreement is being signed between the parties, the same day the public announcement for the open offer has to be made. In case the acquirer is acquiring shares from market, so before placing the order with the broker, the public announcement for open offer is to be made. And in cases where the open offer is getting triggered pursuant to preferential allotment, then upon approval of board of directors of the company, the open offer is to be made by the acquirer. Now coming on to the provisions with respect to completion of acquisition. So once the open offer is made, immediately you cannot consummate the share purchase agreement or the transaction pursuant to which the trigger has happened and the open offer is attracted. So the acquirer has to wait for 21 working days post DPS. Why 21 working days? Because 15 working days period is for that competing offer window, and thereafter another 6 days, wherein post that they can deposit 100% in the escrow account, though the obligation initially is of 25%, but they can deposit 100%, and then they can consummate the transaction which they have entered into with the exiting promoters, and can take charge of the company. And because the objective of the regulation is to secure the amount which is to be paid to public shareholder. Once it is there in the escrow account, then of course the transaction can be completed and the acquirer can come in control and change the object, name and everything of the company and start their business. And the open offer process can run parallelly. If the transaction is triggered pursuant to preferential allotment, then within 15 days from the shareholders approval, the allotment has to happen. The initial transaction has to be completed, subject to the acquirer if has deposited 100% in the escrow account, or the shares which would be allotted if they have not deposited 100%, then those shares would be kept in demat escrow account and no voting rights can be exercised unless the open offer is completed. So in general scenario, once the open offer is completed, then only the initial transaction pursuant or the underlying transaction which has triggered the open offer can be completed. But there are exceptions given in under regulation 23 of SAST, wherein the transactions can be completed during pendency of open offer. Coming on to the withdrawal of open offer cases, as sir has mentioned, so only few situations are envisaged and mentioned in the regulation. If any statutory approval was required and not received for the transaction, if the acquirer was natural person and has died during the open offer period, or there were any conditions in the share purchase agreement or the agreement pursuant to which the transaction has triggered and is out of reasonable control to complete. So in those circumstances, the open offer can be withdrawn, and there can be other circumstances which SEBI may deem fit and instruct the withdrawal of open offer. Otherwise, in all situations, open offer has to follow. As sir also mentioned, recently there was a case where the instruction has been given to pass a reasoned order. Why can't the open offer can be withdrawn? So presently law envisage only these conditions, and we may see certain amendments in these provision coming ahead. Then the other part of the regulation which talks about one was about the triggering events where the open offer is attracted. Now there are certain situations where automatic exemptions are available under the law, and where no requirement to open offer is casted over the acquirers or the person acting in concert. So regulation 10 talks about those things which allows automatic exemption subject to compliance of conditions which are written in specific clauses, and subject to filing of reports which are there under the regulation with the fees which is to be submitted to SEBI for the processing of or understanding of that automatic exemption cases. And there is another set of situation whatsoever is not covered under regulation 10 would automatically go under regulation 11 if there are reasons to seek exemption, and if the open offer can be infructuous in those cases. So the acquirers or the applicants may file the application to SEBI under regulation 11 for making them understand why the open offer requirement should be waived off in those scenarios. Specifically, we have seen in recent 8-9 years that a lot of cases where trust is being inducted in the promoter and promoter group, for those cases exemptions were sought from SEBI, and SEBI has also for the ease of filing of application and fast processing of cases, SEBI has issued circular long back which guides all the applicants as to how the application is to be made, how the trust deed should be there, so that the exemption orders can be passed on a faster basis, and exemption can be granted where it is genuinely not very significant to make an open offer. Now, talking about the situations which are there under regulation 10, so first case is about interstate transfer, where interstate transfer amongst the immediate relatives or interstate transfer amongst the promoters who has been shown as the members of promoter group in the shareholding pattern for last 3 years, amongst the group companies or PAC who has been disclosed in the shareholding pattern as PAC, or shareholders as shareholders in the shareholding pattern. So in all these cases, when they are acquiring shares amongst themselves, then the interstate transaction can happen, and they can cross the threshold of 3-1 or 3-2 as the case may be, without attracting the requirement of open offer. However, there are two conditions that they must have complied with the transferor and transferee must have complied with the disclosure requirements of Chapter 5 in last 3 years. And the pricing at which the interstate transaction is happening should not be beyond 25% of the price which would be calculated as per regulation 8, or the pricing mechanism which is given under takeover regulations. Other exemptions talks about the exemptions in the ordinary course of business, pursuant to any agreement of disinvestment, pursuant to any scheme of arrangement, pursuant to resolution plan approved under Section 31 of IBC, acquisition pursuant to provision of securities and reconstruction of financial assets, enforcement of Securities and Trust Act, pursuant to delisting regulation. So there are various other conditions given within these provisions, which if complied with, then the exemption would be granted, pursuant to acquisition by way of transmission, succession, inheritance, in cases of default of payment of dividend to the preference shareholders, because they automatically gets the voting rights. So open offer requirement may get attracted, pursuant to and the acquisition by lenders in cases of corporate debt restructuring scheme, voting rights on forfeiture of shares, or an increase of voting rights beyond the threshold limits, buyback, right issue. So all these cases where automatic exemption provisions are given, the SEBI has also given the conditions which needs to be taken into consideration, and then the automatic exemption is available. So that is all from my side, and I would now like to introduce Mr. Nitin, who can further speak on the delisting, as well, so further speak on the disclosure as well as the pricing, offer size, and other parameters which are laid down under takeover regulation. Thank you. Thank you. Over to you, Nitin.
Yeah, thank you, Ruchika ma'am.
Go for slide share mode. Okay.
Yeah, thanks, Ruchika ma'am, for this wonderful explanation over the takeover law. First of all, I would like to thank Pawan sir for giving this opportunity for speaking in this webinar. As already mentioned by the Pawan sir and the Sudarshan sir in the initial, that the core of the takeover law is to give the fair play in the exit opportunity and to give the fair change in control, so that there is a fair exit for the shareholders. In this process, there are three things. First is fair offer size, fair offer price, and the fair offer process. Let's discuss each in detail. First, moving for the offer size, as Ruchikama mentioned, that in the case of mandatory offer, the minimum open offer size is at least 26% of the total share. And in case of the voluntarily offer, it is at least the 10% of the voting rights. For calculating the offer size, the total share as of the 10th working day from the closure of tendering period shall be taken into account. That means, for an example, as on the date of PA, if there are 1 crore shares in the company and there are 50 lakh convertible debentures, then the open offer is to be given for the 26% of 1 crore 50 lakh shares. So the potential increase include the number of outstanding share as on the date of the PA, and increases proportionately the total number of share rises in the manner not contemplated on the date of PA. One interesting fact to be noted here is that since the mandatory open offer size is 26%, however, in the cases where the target company promoters are already holding more than 74%, in that scenario, since the public shareholding is already less than 26%, in that case, the open offer size can be less than 26%. Further, in case of the event of the open offers, where the after tenderings, if the acquirer shares has increased beyond the 75% limit, then they have to reduce as per the SCRR rules within the prescribed time of 12 months. Further, in the takeover law, there is a recent amendment which has mentioned about the proportionate reduction. So, if there is the breach of the 75% threshold, pursuant to the SPA and pursuant to the tendering under open offer, then the acquirer may plan to proportionately reduce its holding to meet that MPS limit. Moving ahead toward the offer price. For calculating the offer price, we first have to determine whether the shares of the company are frequently traded or infrequently traded. The shares will be said to be frequently traded when there is the annual trading turnover of more than 10% in the last 12 months preceding the calendar month of the PA. So, example, if we are giving the public announcement of the company in the month of July 26, then we have to check the annual trading turnover from July 25 to June 2026 to check whether there's a turnover of more than 10% or not. So also it is important to note that if during that 12-month period there is a change in capital of the company, then we have to calculate the weighted average number of shares for determining the ATT. Also, it can be seen that there are many companies where the shares are frequently over the one exchange and infrequently over another. In that scenario, the shares will be treated as frequently, as it is mentioned that on any stock exchange there should be a turnover of more than 10%. Moving ahead, if the said we our companies are frequently traded, then the offer price will be calculated being the highest of the following four. First, the highest negotiated price paid per share under the agreement, like share purchase agreement, the volume weighted average price for the acquisitions made during the 52 week preceding the PA, the highest price paid for the acquisition made during the 26 weeks preceding the PA, and the volume weighted average market price for the 60 trading days preceding the PA. Let's understand the calculation of each in a quick. Assuming our PA date is 31st March. In that scenario, we have to check the ATT from March 25 to February 26 to determine if our company is frequently or infrequently. Supposingly our company is frequently, and so first we have to check VWAP for the 52 week preceding the PA. As mentioned in the second and third point, the VWAP and highest price, these points will be applicable only when the acquirer is holding certain shares in the target company. So, in our example, we have mentioned the 5 dates in which the acquirer has acquired certain shares at a certain price and the consideration is mentioned. So, the VWAP will be calculated by the total consideration divided by the shares acquired. So, in our case, it's 100.72. Further, we will check the highest price paid, which is 104.70 in our case. And then we will determine the VWAP of the market price for the 60 trading days preceding the PA, which also it is interesting to know that the trading days here mentioned below is the trading days of the exchange, not the trading days of the target company. Uh, so, example, if there are 35 trading days of the company. Our company is traded in the last 60 out of only 35 trading days. Then the VWAP will be calculated only for the 35 trading days to determine the VWAP market price for 60 trading days. So in our case, we have taken the details VWAP shares traded. So VWAP contribution will be calculated on multiplying the weighted average price with the number of shares traded, and the volume weighted average market price will be calculated by dividing the VWAP contributions by the share traded, and in our case it's 104.65. So considering the example and assuming that SP has been entered at 110, so the open offer price will be the minimum will be the highest of all the offer price determined, which is 110 in our case. So the acquirer has to give the open offer at the minimum price of 110. Further, in case the shares are increment traded, where the turnover is less than 10%, in that scenario, the first 3 points will remain same. However, since there is no market trading, so the valuation is to be done from the independent registered valuer, which is recently amended. Lastly, there was the merchant banker has to do the valuation. As per the recent amendment, the valuation is shifted to the independent registered valuer. Further, let's move toward the offer process. The offer process started with the triggering event. The triggering event, as well explained by Ruchika ma'am under Regulation 3.1, 3.2, and 4. After the triggering, on the same date, the PA has to be made. There are different timings for the different events, so PA has to be made accordingly. Within 5 working days from the date of PA, the detailed public statement is to be published in the English, Hindi, in the newspaper where the register or target company is situated, and in the newspaper where the stock exchanges are located. Prior to DPS, at least 2 working days prior, the escrow account should be opened in which the funds are to be deposited by the acquirers. We will discuss in detail the escrow account in next slides. Further, after publishing the DPS, the draft letter of offer is to be filed with SEBI along with the fees and with the merchant banker DD certificate within 5 working days. Post the draft letter of offer, SEBI will give its comments. After the receipt of the SEBI comments, the letter of offer is dispatched to the shareholders within 7 working days. Post next five after the 5th working day, the tendering periods need to be opened, and it should remain open for 10 working days. Further, after the tendering period closes, the payment is to be made to the shareholders within next 10 working days. Post that, within next 5 working days, the post offer advertisement is to be published in the newspapers in which the DPS was published for telling the to advertise that the how much shares has been tendered and that details. Further, between prior to the tendering offer process, there is one independent address recommendations to be published in the newspapers. The independent editors of the target company has to give their comments on the offers. So their recommendation is published in the newspaper in which the DPS was published, and they can hire the advisors for a recommendation on such offer price. All such offer process is there are various formats. There are various of the public announcement DPS, which is well explained under the SEBI Master Circular of the February 16, 2023. According to that format, all the offer documents need to be prepared. Next, now moving to some important aspects under the offer process. First is escrow account. The escrow account needs to be open at least 2 working days prior to the date of DPS, and this objective is to ensure the performance obligation by the acquirers. It can be in 3 forms: cash, bank guarantee, frequently traded, and freely transferable securities with the appropriate margin deposit in the favor of merchant banker. Now, what's the quantum of escrow? How much amount is to be deposited in the escrow account? That depend upon the offer size. Assuming our offer size is less than 500 crores, then the 25% of amount of consideration is to be deposited in escrow account, and later on additional 10% is to be deposited. Further, in case of conditional offer, the escrow account should be the 100% of the minimum level of acceptance or the 50% of the consideration payable, whichever is higher. Further, there is a provision of upward revision. In case the acquirer wishes to revise its price upward, then in that scenario, prior to making the upward revision, he has to make the necessary arrangement in the escrow account. Further, in case of bank guarantee and securities, the at least 1% is to be deposited as a cash in the escrow account. The escrow account will be released within 30 days from the date of payment to all the shareholders. Next, moving to the obligations of the acquirers and target company. The acquirers are majorly obligated to not to sell any share during the offer period for the financial arrangement before giving the public announcements. The target company is obligated to conduct the business in ordinary course, not to take any actions without the shareholders' approval or special resolution like of asset sales, new voting, securities. Further, no record date is fixed from the 3rd working day before the opening of tendering period, and so on. Now, the crucial aspect after the fair exit is the of the law is the transparency. The transparency occurs through the disclosure requirements. So there are the event-based disclosure under 29.1 and 29.2. 29.1 applies on acquiring 5% or more of the voting rights. The very first time when the shareholding increases the 5%, it has to give the disclosure on 29.1. And whenever the person is holding more than 5% and there is a change of more than 2, then it has to give the disclosure under 29.2, and that is to be given within 2 working days of the intimation of allotment or acquisition to every stock exchange where the company is listed and to the target company. The disclose under this chapter 5 for computing the 29 regulation disclosures, the convertible securities will also be regarded as shares. So whenever any warrants are allotted or any warrants are converted into equity, at that time we also have to check whether there is any disclosure requirement or not. Moving ahead, further, there is a one annual disclosure requirement of encumbered share under Regulation 31(4), where the promoter of the target company has to disclose on yearly basis within 7 working days from the closing of financial year that whether there any shares has been encumbered or not. So let's understand the disclosure with the example. On 1st April, the Mr. A is holding 3.20% and has acquired on market 2% and it breaches a threshold of 5%, then it has to give the disclosure in 29.1. Similarly, if it's holding 7% and there's on market sale of 3% and post sale there is holding of 4%, so there is a change of more than 2%. So 29.2 is triggered. Further, there are disclosure requirement under the exemption law, as explained by Ruchika, and there are various exemption. So, for claiming that exemption, there is also a disclosure requirement. And in some scenario, in like in interest transfer, there is a prior intimation to stock exchange and 10.5. 10.6 is a compulsory disclosure requirement, which is to be given in every case of claiming exemption. And 10.7 is a report to the SEBI to be filed within 21 working days of the acquisition in certain specific scenario as mentioned under the regulation. So in let's understand some interest transfer with the disclosure example. So if Mr. P and Q have both been shown as the promoter in the shareholding pattern for last 3 years and having the total shareholding of 35%, and since as per the example, Mr. P is acquiring Mr. Q is acquiring 6% and P is selling 6%. So there is a 3-2 breach on Mr. Q. So pursuant to that, he has to take exemption under regulation 10. So he has to first submit the 10.5 regulation, 10.5 disclosure at least 4 working days prior. Post the transfer 29.2, since both of them are holding more than 5%. Post that 10.6 disclosure need to be submitted, and also in that scenario 10.7 is mandatory applicable to be filed with the SEBI. Now, since the SEBI has automated certain disclosures and system-driven disclosure has been implemented, so many disclosures requirement has been dispensed away. However, there is a manual filing in certain, like where the individuals are holding with PAC, and there is a trigger requirement when there's a trigger requirement when individual and PAC is triggering the disclosure, like Mr. A and Mrs. A, both are holding 4.5% and Mr. A is only holding a 3%. After having 1% acquisition, their combined holding reaches to 5.5, and that breaches the combined disclosure requirement under 29.1. So that disclosure is still to be manually filed. Further, where the PAN has not been mapped or provided to the depository. Also, it is pertinent to note that these disclosures SDD are under 29 and regulation 31.
Nitin, we have to bind up because two more
Yes,
speakers
sir.
are
Sir,
there with question
done.
answer.
It's done.
Yeah.
Yeah. So the SDD requirement is for regulation 29.31. However, for the regulation 10 disclosures, still manual filing is to be done. That's all from my end, sir. Thank you.
Okay, now thank you, Nitin and Ruchika, for giving the elaborate presentation. Now, Ravi, Manoj, you will speak first. Ravi, you will speak, and then Manoj will take up question answer. So, your case law, the important case you just discussed, which is later like one withdrawal of the offer, which was already there, and one in other cases which are very important, recently passed.
Certainly. Thank you so much, sir. So I'll just start with, maybe I'll take 2 minutes before I come to this specific point. Whatever the speakers before me have spoken, and they have covered so many regulations, so many permutation and combinations of triggering thresholds or disclosures. All of them are tripwires which may result into a violation. And this takeover law is one of probably one of the few laws that you should not remember only to ensure a compliance. But this is one of those laws wherein not necessarily a wrong step or a non-compliance would only have ramifications. But if you do a perfectly commercial arrangement and skip about the nuances of it, it may also result into consequences. That can be requirement to make an open offer, to losing an exemption, to facing penalties, and the canvas is really broad. So one is that, and then the other kind of issue that may arise in it is that if one is not very meticulous in planning a transaction, one may lose the rights that they may have to go back on that transaction itself. And that is the part Pawan sir suggested, and I think Sundareshan sir also hinted at it in the beginning. I'll just quickly go to that straight away. Recently, I think 2 weeks back, SAT has passed an order in a case where an open offer was filed, in that there were two primary transaction documents through which the open offer was triggered. One was the SPA, and the other was a subscription agreement, share subscription agreement. One of the condition, as usually is contained in any SPA or SSA, is of material adverse effect. So in that, it was envisaged between the parties that if the net worth of target company goes below a certain threshold, the transaction would be terminated. And the transaction indeed got terminated because the net worth fell below that stipulated threshold. The interesting issue that arose that in takeover regulations, there is a regulation 23, which allows that withdrawal of an open offer. One clause requires approval of SEBI, without which you can't withdraw. There are a couple of other clauses which allows an acquirer to withdraw an open offer. The language of that clause is peremptory, but that's not topic of the day. So one of the clauses regarding the statutory or regulatory approval. There is another which is known as 23(1)(c), subregulation 1 clause C, in which if in the private agreement or the primary transaction documents, there is a condition stipulated which could not be adhered to by the acquirer or which gets frustrated for reasons beyond the control of acquirer, then they have to make certain reportings and can withdraw open offer. This was that case that surrounded this particular issue. And what ultimately SAT observed is that there is a power under which acquirer can withdraw. But in that particular case, SEBI had not given a speaking order. So that matter is now remanded back to SEBI for deciding. But see, here is the takeaway. If anybody is planning to go ahead with the transaction, and certainly all takeovers are commercial decisions. So therefore, it is very important that acquirers and their advisors must see that they are drafting the open offer documents with these clauses embedded into it, taking care of the disclosures and open offer during the open offer process, and start engaging with the regulator if at all the situation arises in a timely manner, not in hindsight or as an afterthought. So this is one part. Second is much water has flown under the bridge since the judgment of Sunil Krishna Khaitan by Supreme Court, which says that open offer in every matter should not be imposed as a condition, because even the takeover regulation gives a slew of measures in the hand of regulator, primary one being directing that an open offer should be made. But what happens if open offer, if at all brought today, in today's circumstances, would not be in the interest of investor, would be against the interest of investor? So that's one yardstick on which the requirement of making or not making open offer could be tested, and it has been tested in past. Although statistics are the statistics lean in favor of making open offer, but you would find cases where the direction came that maybe open offer is not required. So I'll just quickly tell what happens. So if somebody violates the trigger thresholds, be it any 3-1, 3-2, 3-3, or 4, or a conjoint reading of either of them, one is the requirement to make open offer, and if somebody defaults on it, actually there are two violations. One is that offer not made timely, for which you can go for settlement, but that settlement would not condone the requirement to make open offer. You'll have to satisfy the regulator that there is no requirement to come out with open offer. And for other disclosure violations, because all those are disclosure violations, certainly the window of settlement remains open. But in that also, the disclosures must be made or corrective actions must be taken to the extent possible. So my message, or not advice, but an indication to all in the audience, and those who are the relevant stakeholders who may have dealt or would be dealing with this law in future, is that here you should look at the historic record, identify if there are any infractions, and go clean, because usually a violation of takeover code does not sit idle. It may hinder your future corporate restructuring, maybe a rights issue when you do a buyback or a merger. It might resurface and create some problems there. So that's all from my side in the considering the paucity of time.
Okay, Manoj, your whatever Mr. Sundaresan, myself, Ruchika, Ravi, they have not spoken anything which is remaining. You please tell.
Yeah, I think everything is already covered in much detail. Obviously, this regulation need quite a detailed overhauling, considering the situation, considering the changing market dynamics. Many of the things are quite hindering in the ease of doing business, and also timeline is also very long for many commercial transactions. So we should try to adopt more fast forward kind of regulations, and that would help everyone in the capital market, larger companies and others. So the purpose is various of the provisions are not serving the purpose for which it has been made. And Sundaresan sir has very rightly said that these provisions need overhauling. Like in case of if there is possibility of majority of minority approval, then exemption from the offer may be given. Withdrawal of offer in many of the cases could be very relevant. Then the window for, let's say, very liquid shares, window for tendering price can be window for tendering can be reduced from the very first day, and if the price goes much beyond that and liquidity is there, then exemption from offer may be given. So all such kind of review is very much relevant, and we should consider, regulators should consider that. So let's discuss in the Q&A session. If something is left out, we will try to address.
So you mean to say that there's a time that revamp the takeover code?
Yes.
Session, sir. Now,
15 years is quite 12 years, 11 years is quite a long time, sir, for these kind of dynamic laws.
Okay. Just call sir. I think he was not able. Yes, sir has come. Sir, Manoj is saying that it's a time for revamping the entire takeover code, and you are also echoing on the different way that the offer requirement must be matched with today's need and practical aspects of all these issues. So my first question is, do you think that takeover law requires overhauling, or it requires just some fine tuning?
Incidentally, it's available in public domain. Yeah, 2 years back, a committee was constituted just before Margal Madam as chairperson democratic office. Unfortunately, that committee took almost 18 months to come with the new regulation, and therefore, by the time whatever recommendations they were proposing, did not take into account those 18 months period, because they all went in the past and other things. So probably that's why that committee has been made almost like extinct now. So there is always a fight need within SEBI, and that's why this committee was constituted 2 years back. It is on the SEBI website. the constitution of the committee and all. But then probably, definitely, see, as Manoj said, it was made in 2011. Today, 15 years have gone. We need to definitely have a rethink on that. And as I said, do we need to allow withdrawal? Do we need to allow force people to make open offer? Timelines, perfectly said. Now in buyback, delisting and all, timelines are being halved. At one point of time, under delisting, it was taking 180 days. Today, delisting gets completed in 40-45 days if you do everything on a clear manner. So here also, definitely timelines can be reduced, and many other things can be, revisited. I'm not talking whether you keep 25 or 30%, people will tell why 30, why not 35. So for that, there is no anybody can give logic, but that there are many cases where exemption orders are being passed. Why not we put all of them in the automatic exemption route?
Right.
Why unnecessarily go to SEBI, a panel, then go through, and then sometimes it takes 6 months to get an exemption order. Till the time the pendulum is sword is hanging, for some reason the exemption doesn't come through, then that is a cost of doing business, no? So definitely, in my view, 10 years is the shelf life of any regulation. I don't think any regulation
Right.
is what,
Well said. Well,
10 years. Of course, frequent amendments are being made, but even then, it is better to, and see whether certain obligations can be, given up. Those obligations were made at one point of time. Are we still, or some other obligation need to be brought in? Either way, it can be seen.
Okay. So now, what checks and balance does SEBI have to install and stop a takeover of a listed company by none other than the promoter who is under investigation for one of the biggest fraud which was discussed last Friday in the forum? Is this whistleblower protection available? I'm sure SEBI will be clueless about this imminent takeover. I think this is a personal comment. I'm not asking questions to the panelists because this is very embarrassing. We are not, because this is a knowledge session. We don't comment on any company, anything. Yeah. If promoter are not submitting regulation 31(4) compliance under SEBI SST, can stock exchange penalize the company for this? What action can stock exchange take against company and promoter? Ruchika.
Sir, every regulation has the obligation on promoters, not or the acquirers, not on the target company. So any penalty, if required, can be penalized by SEBI on promoter or acquirer, not by the stock exchanges on listed company.
Okay. Can a person acquire 5% on 31st March, another 5% on 2nd April within the limit of 75? Yes, it is allowed. Any limit is there for company offer, competing offer?
Sir, for competing offer, the acquirer who is making competing offer should have at least those much shares which the initial acquirer has given open offer for. Otherwise, there is no such limit. He has to follow the entire procedure of open offer.
Okay. The definition of control continue to remain one of the most debated concepts. Why has it remained so difficult globally?
so obviously, sir, this is
So my
Right.
question, the question is, the control definition remains always debatable. I'm just asking whether this is available in the entire other jurisdiction also. They are also facing same thing, or it is only in India?
Control will always remain subjective because percentage of holding, if it is a direct threshold, let's say someone is holding 51%, more than 50% directly, and having full right to change board structure, etc., then there is no question of ambiguity. However, I mean, many of the cases, promoter holding is less, but the control is there, or even a very small holder can have indirect or direct right to manage the affairs of the company. So control will always remain because of these dynamics in the market, economic dynamic in the market. It will remain a
Okay.
disputable issue.
So, Deshan sir, you have any view on the control and compared to other jurisdiction? Okay. When sir will come, Ravi, you have any view on this?
I think the more we have, first of all, we are probably the only jurisdiction who have over legislated on control. Otherwise, there are in principle tests outside. We were the only jurisdiction who thought about bringing a bright line test on control. But but the experience shows that it's very complicated people structure and it's fact to fact. You can't put a straight line to it.
Ruchika, two questions. Which provision of this regulation create maximum problem for the professional merchant banker, and which is the maximum problem to the promoter?
Sir, maybe maximum problem for the acquirer is to deposit 25% in the escrow account without having any interest for the period of 3 to 4 months, which sir was also mentioning, because they can use it for their business or any other, any other substantial thing, but not by just keeping in the bank account for the safety of public shareholder. For the merchant bankers, I see that there are very crucial timelines to do a lot of things, and we have to, if we breach anything, then there is a hefty penalty or provision. So it can creating documents, filing in the specific timelines, those can make a little more automatic, or maybe in a form or something, through AI, so that we need not to prepare the entire 50-60 document of draft letter of offer and then the letter of offer and all repetitive content. So that can be changed, can be automized.
Okay, sir.
Similarly, if the earlier also it was suggested, but then for some reason it was not implemented. If the acquirer is a listed company, all the disclosures about the acquirer is available in the public domain. Why in the offer document we print another 10, 12 pages about the acquirer? I don't understand. Because again, the offer document, how many people read. If a company comes up with an IPO, I can understand you give the complete horoscope from the time you are born, what you have done, everything. But if the acquirer is a listed company, I don't think insisting on disclosure again, who is the promoter of the company, what is that, and all those things is these are all drafting takes more time, because somewhere you say that acquirer is a MTech. Now, some question will come in the public issue which was made 10 years back. It was not shown. When did he acquire this qualification? So, all these things will, delay the process. So, it is better that we restrict, that's what I say. These are all the changes one has to think. At one point of time, this type of detailed disclosures are not available in public domain. Today, so many things are available. Why do we want these things to be made again and again?
Okay. Sir, one question which was there, the control is still a problem in India or other part of the world also?
Sir, I don't think it is a problem in India. As I said, Jet Airways, after the Jet Airways order, SEBI has categorically said what is presumptive rights, what is protective rights, what is the rights which will attract control. I think all these three buckets are clear. If people want to circumvent, definitely they will get the, what you call stick from SEBI, and then they have to face the music. Otherwise, recently there are cases where it's a, widely, it's a promoter-driven company where somebody acquires 20%. Nobody complained that, that they have acquired control by 20%. But the existing promoter holds only 24%.
Okay.
So it is clear, because that was a clear investment, and even the proxy advisories initially was a little apprehensive, but even the investor paid some sort of control premium and to the promoter. So that does not mean that the person has acquired control, because without that person's work he can't even get 20%.
Okay.
So one has to see the facts of the case. So now I can say the line is almost close to 90-95%. The gray area may be 3-4%, but that is also, I don't find any case where SEBI has passed an order telling that you have breached the control, but you have not made open offer in the last 10 years.
Okay.
To the best of my knowledge, Ravi may have better data than me, because he may be following up on a daily basis on this case laws. But to the best of my knowledge, on control violation, I don't think SEBI has come on heavily on any acquirer.
Okay. Richko, interest on escrow is allowed?
Sir, it is there in the law, but the bankers do not have any mechanism to offer it. So that's again a practical challenge. Also, you were mentioning about the challenges under takeover regulation. One additional challenge is with respect to regulation 3.3, which talks about the shareholding is to be checked on individual as well as aggregate basis. So there are varied views. Even when preferential allotment is done in listed entities within the promoter and promoter group, any person specifically is attracting 3.2 individually, but not aggregately. So whether the open offer should be made by the promoter and promoter group again for 26%. Clarity is still required. FAQs should be reworked upon it, and thereupon clarity would be there in the industry.
Okay.
Mr. Pawan,
Yeah.
escrow account by nature does not carry interest.
Okay.
This point also, debate is going on. I know that, we need to open a sort of a special account. This escrow was actually, the meaning was it should be a special account. But unfortunately, banking terminology is understood by SEBI differently. So we have used the word escrow account. And bank says once it is an escrow account, no interest will be paid. So this needs to be revisited 100%.
So, but the advantage is bank is taking without giving anything, like say 400 crore I'm depositing and no interest.
No, but that is because it is called escrow account. So the problem is in the wording in the regulation, but it was not intended at that point of time.
Okay.
See, these things needs, that's what I said, 10 years, the wisdom we have to 26, we need to have in 16, no? Or in 10.
Okay. So the registered valuer in place of merchant banker, it has come or it is still there?
It has now come, sir. The amendment was
Okay.
there. Yeah.
One participant saying biggest problem is identification of PAC and ambiguous control definition.
That's there.
Okay. Interest easily encash in all our deals. So
Comment by someone.
I think you can contact Lekha Nair that how she's getting escrow accounts interest this way. Okay. Now, Ravi, has the settlement process improved this compliance culture of takeover law?
Certainly, it has improved relatively, but not in absolute terms. There are a lot of hidden scorpions in settlement process also.
Okay. Manoj, do you think with increasing of PE investment, startup acquisition, do you see any further amendment becoming necessary to catch hold of, to identify and solve the problem of these people?
The situation, the definition we have discussed relating to the control part or person acting in concert part, all those things is differently understood in the startup culture, because they are there in most of the cases there is no identified promoter in such cases, and then having person acting in concert to a professionally managed company is also a ticklish thing. So obviously for all those things, like sir was clearly saying, 15 years is a long time. Whole economic dynamics, capital market dynamics have changed over this period. So we need to modify, we need to adapt to the new changes, new dynamics, and amend the law.
Okay. Okay. Now we have overshooted already.
Yes.
Time is we are crossing. Last question. Do you get exemption for crossing 3.2? In PG has renounced his entitlement in right issue. As the section says, acquirer should not have renounced, and PG is general assured to be a PSE.
Under regulation 10, the condition says that there should not be any renunciation to claim automatic exemption. But if there is any special case, they can of course go under regulation 11 to SEBI.
Okay. So now it's a time to close it. Now all participant 20-25 seconds for all to close this session. Nitin, I'll start with you.
Yes, sir. So, as mentioned, the major objective of the takeover code is to give the fair exit opportunity. So the major reason behind the takeover code is not the compliance part; it gives a fair exit opportunity to the shareholders.
Okay, Anuchka.
Sir, I think diligence parameters for the merchant banker can also be listed out clearly, so that we as merchant banker also know that what is to be done in what all parameters, and there cannot be any straight line to due diligence, but somewhat indicative parameters should be there.
Okay. Ravi?
I think once we are at an inflection point, certainly, I gather from Sir and Manoj sir also. So whenever this overhaul is done or fine-tuning is done, it should not only be done from acquirers, promoter, and investors' perspective. There are a lot of intermediaries who work in takeover and who make it work. So therefore, this everything under the sun type of a standard for diligence and the hindsight chasing of merchant bankers or other intermediaries, this should also come to an end. And timelines should be fine-tuned. They should not be further reduced to make it a headache for a merchant banker. It is all. I think it's already at a snap of finger, the timelines under takeover. So they should not be reduced. It should be rationalized. That's all.
Okay. Manoj?
Yeah, so I think we have given a lot of thought already, discussed the overhauling is required of the entire regulation. Patchworks sometimes creates more problem. So, and the regulation is for the benefit of the acquirer, for the benefit of the capital market. So it should be more simplified and commercially more aligned towards the acquirer and the listed company, which is a win-win for listed company as well as their investors. So that should be the prime motive about these regulations.
Okay. Sir, your final comments?
See, after 1997 regulation, the revision was done in 2011. So effectively, there was about, after 12 years, the talk was felt that it has to be revamped. Then the SOGI committee was formed and the new regulations came into force. Similarly, it was thoroughly changed. If you see, there is so much of improvements brought in based on the experience gained in the last 14 years between 97 and 2011. In the same way, going forward, as Manoj and other people have said, lot of changes have taken place. The market has become more dynamic. Information flow is actually, it is overflow. So definitely it can be revisited chapter by chapter as by any sort of a distinguished committee. And definitely a lot of improvements can be brought in. And new thought process should be brought in. Again, going back to the same, see, 94, 97, 2011, all are under the same broad framework. Acquisition, open offer, this. Now we have to think something different. That, does it serve the purpose? Have they reached to the next stage? Like how we have said, SEBI will not vet the offer document. The vetting is given to the, what you call stock exchanges. Rights issue up to a particular limit, nothing is done because entire information is available. Capital is issued only to the shareholders. So simply file the document and move on. Buyback, SEBI has given up vetting. Delisting, nothing comes to SEBI. Go to stock exchange, file, give reasonable price to the shareholder. If he is willing to tender, go and then. So we need to think in those lines. And then paradigm shift has to be brought in, keeping the latest developments in the market.
Right.
Thank you. Thank you very much, sir. So now, friends, it's a time to conclude today's webinar. I hope that we all are leaving with one thought. The takeover code is not merely a compliance acquisition or regulation. It is something bigger, governance framework, which protect the fairness, transparency, market integrity, and investor protection. This is the thought which has come out today in the session. And today's discussion has shown that success in takeover is not merely memorizing the numbers, the regulation, section, days, what complies, when you have to do. The main understanding is the philosophy behind the law. The applying it wisely in transaction and preparing for challenges of tomorrow. That is a basic purpose which we have done. My sincere gratitude to Sundarshan sir, chief guest for today's program, for sharing an invaluable insight. And the most important point, which is, if I can say, what is the signature point, that every law has 10 years shelf life. And after 10 years, it has to, sometime you can do before also, but after 10 years, it has to take place. And I thank all other participants and the speaker, those who have discussed, and they have discussed this complex legal provision and practical guidance which has provided by Ruchika and Nitin and Ravi and Manoj, and sir has given icing on cake. So as you are aware, friends, the corporate professional mission is remain unchanged to build better professional, strengthening corporate governance and contribute for the more transparent, more trusted, and more effective business environment through this continuous learning which we are doing since last 2020. We look forward to welcoming you again for our next knowledge webinar, which will be on the NBFC we are working out. And next Friday, we'll meet you again. So thank you. Stay safe, stay ethical, keep learning, and keep relearning also, and keep relearning also, and have wonderful evening. So this is my suggestion, and I always say learning is important. Relearning is more important, but unlearning is also very, very important, because what you are carrying, and that is a call breaking the status quo. So let's make it a better governed Indian corporate ethos with this. Thank you. Good night.